This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 509 was produced on December 4th, 2025. I'm Eric Townsend. Politics and geopolitics are likely to be major drivers of markets in the 2026 midterm election cycle. So we're bringing back BCA Research Geo-macro strategy chief Marko Papic is this week's feature interview guest. We'll discuss the deteriorating situation in Venezuela, the impacts of potential Russia-Ukraine peace deal on markets, the spat between Japan and China, and the U.S. midterm election cycle, considering the market implications of all of these developments.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, December 4th, 2025. The S&P 500 index up 123 basis points, trading at 68.49. Markets settling down near year highs, waiting for next week's FOMC. We'll take a closer look at that chart and the key technical levels to watch in the post-game segment. The US dollar index down 91 basis points to 98.87. The first close below the 50-day moving average in 2 months, begging the question if the recent dollar strength is over. The January WTI crude oil contract up 243 basis points, trading to 59.36, sitting just below a key resistance line. The January RBOB gasoline up 167 basis points, trading at 183. The February gold contract up 91 basis points to 42.15. The March copper contract up 589 basis points to 539, a breakout to monthly new highs. The December uranium contract up 20 basis points, trading to 76 even, and the U.S. 10-year Treasury yield up 8 basis points, trading to 409. The key news this week is Friday's core PCE price index, and next week we have the ADP employment change and JOLTS jobs openings, PMI inflation numbers, and the much-anticipated last FOMC press conference of the year. This week's feature interview guest is BCA Research Geo-macro strategy chief Marko Papic. Eric and Marko discuss Venezuela, Saudi Arabia, and its impact on oil prices, Japan-China tensions, U.S. politics, Kevin Hassett, and more. Eric's interview with Marko Papic is coming up as MacroVoices continues right here at MacroVoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Marko Papic, Geo-macro chief strategist for BCA Research, very well known for his geopolitical and political commentary regarding markets. Marko, let's dive right in because there's so much to talk about this week. I think Venezuela is probably the first thing on everybody's mind. Normally, if you're going to start an air war, the first thing you do is declare a no-fly zone through a very well-defined military and political protocol. President Trump did it a little bit differently. He did it on Truth Social instead. What should we make of that? Is that an official no-fly zone, or is that just the president kind of expressing himself? What was that?
I have no idea, to be honest with you, but we have to take President Trump's tweets, socials, whatever we're supposed to call them nowadays. We do have to take them very seriously. He's declared trade wars. He has declared peace treaties. He has declared new geographical names. So I think that we have to take his warning that you shouldn't fly any airplanes over Venezuelan airspace very, very carefully.
Well, certainly that is being respected. If you look at FlightAware, you can see that all the airplanes stopped going into Venezuelan airspace because they don't want to get shot down. What's coming next? Because if this had been through the normal Pentagon channels, I would say, okay, if they're declaring a no-fly zone, it means they're about to start an air war. But, if I look at President Trump's track record, he tends to like to go into negotiations with big, tough talk and then negotiate some different settlement. So how should we interpret this? Is it a prelude to an air war, or is it maybe just President Trump setting the stage for a negotiation?
I mean, I think you've nailed it. I agree 100% with you. I think that President Trump has very defined 7 steps to maximum pressure, as I've articulated it and called it for my clients. My frameworks worked really, really well. For example, I never really got bearish this year. Not on April 2nd, not on April 10th. He was talking very tough about tariffs. He likes to punch people in the mouth, in the face. He triples down on it just when you think he's about to start negotiating. And then he starts negotiating when you least expect it. So I do think this is a prelude to negotiations. Maduro, according to just press reports, I mean, I'm not sharing with you anything that is not public knowledge, but Maduro is very clearly offering quite a bit to President Trump. And I think that President Trump, being the negotiator he is, he understands that he has a lot of leverage in this particular situation. And so he's just, asking for more, as I think is the objectively correct thing to do. Now, I can't tell you what happens over the next, let's say, 30 days, but I can tell you what does not happen beyond that. There will not be a ground incursion into Venezuela. You can be assured of that. There will not be a war between the United States of America and Venezuela. And the reason for that is that President Trump is very clear that Afghanistan and Iraq were tragedies, a waste of resources, and probably the dumbest foreign policy move in American history. And so I don't see him repeating something that he clearly abhors in Venezuela. But will he turn Venezuela into a parking lot if he doesn't get what he wants from Maduro? I think it's 50-50. It could happen. And that's something that the United States of America can easily do, particularly in this part of the world. Venezuela has no ability to defend itself. The U.S. will basically conduct a suppression of enemy air defense operations within a week. And then after that, it will be able to bomb whatever it wants in Venezuela for as many months as it wants. So, yeah, I mean, Maduro is definitely on the clock here and has to offer a better deal to President Trump.
Now, Venezuela has more oil reserves than anyone, so I could see this going one way, which is if there's going to be this military conflict like you've described, it could potentially put a real upward pressure on oil prices as people get afraid about supply. But boy, if President Trump made some kind of deal for U.S. oil companies to really develop Venezuela, because a lot of its resources have not been efficiently utilized, that could be a long-term, very bearish signal for oil prices, because it could mean that we're about to, go and redevelop a bunch of untapped resources. What do you do in a case like this? Which way do you bet, if at all, in markets?
You never really asked me why is President Trump doing this, but you're answering it, right? And I agree with you. This is the answer. But why? Why now? Why on December 2nd, 2025? Why the urgency? Is it ahead of the midterms? I don't know. I mean, it seems to me like it will be politically more convenient to do something like this after the midterms, when all the risk of getting flack in Congress, as President Trump is getting right now, for some of the, dubiously legal military operations. Like, who authorized this? For what reason? How is Venezuela threatening the United States of America? These are all risks. So why is he taking these risks right now? And I think the answer to this is quite oil bullish. So there is no world in which America replaces Maduro and oil starts flowing within the next 12 months. That is a fantasy. And if somebody sold that fantasy to President Trump, who is not exactly knowledgeable of how energy works, well, that somebody is obviously trying to get something accomplished here. But there's no world in which America defeats Maduro, whatever that means, and suddenly oil starts flowing. So I don't really see a bearish outcome for oil prices, at least not in the next 18 months. You're right, Venezuela has a lot of reserves, but you got to understand, this has been a country run by communists for the last 25 years. They've destroyed the productive capacity of PDVSA and of their engineering and servicing. No amount of American service companies are just going to show up and turn on some magical pipeline. That's not how the world works. So then again, what's the urgency? And I think that the answer to that question may be the meeting between the Crown Prince of Saudi Arabia and Mohammed bin Salman 2 weeks ago in Washington, D.C. with President Trump. Saudi Arabia has been a very good partner for President Trump and the U.S. administration. They've kept OPEC production very high. oil prices have been very low throughout this year, even with all the geopolitical stuff going on in the Middle East. And it's clear that Mohammed bin Salman has said to President Trump, look, I know what's your number one political issue. It's CPI, it's inflation. I'll help you with that. But Saudi Arabia has its own domestic political logic. I mean, it's trying to nationalize, nation build, rebuild the whole country, move it away from oil revenues, build industry, build new parts of the country. And for that, you need oil revenues. Saudi Arabia cannot just do America's bidding forever. At some point, they're going to need Brent crude prices to be higher than $60. Not like at 100, but let's say 70, 75. I suspect that Mohammed bin Salman came to the United States of America 2 weeks ago and very politely told President Trump, like, look, I gave you 12 months. You told me CPI is important to you. Inflation is a big deal. I gave you that. I can't keep doing this forever. I know midterms are coming up in November, but I need some of that oil revenue too. And I suspect that's where the urgency comes from. The U.S. needs to find another source of crude because they know that the OPEC production policy is going to change in 26. There's going to be less supply on the market in 26. And so that's where I think the urgency of this comes from. And I think that there's nothing but upside to oil prices in that case because it means OPEC production is going to have to be cut. Saudi Arabia probably told the U.S. that. And on the other hand, this notion that the U.S. can replace Maduro and voila, there's like 17 million barrels a day of production, I think that's going to be very disappointing because that country's a mess. It's been driven into a third world status, and it's going to take years to get production up.
Okay, I feel like I'm missing something because I agree very strongly with you that if President Trump made some incredible deal with Venezuela and it's going to be really bearish for oil prices, it's bearish for oil prices 5 to 10 years out after they develop a bunch of new productive resources that do not exist anymore in Venezuela. There is no switch to turn back on. So if the issue here is MBS came to the White House and said, look, Mr. President, I've given you, as much room as I can give you. I can't extend it all the way to the November midterms. Expect oil prices to come back up. It seems to me it would be foolish to think that Venezuela has any part to play in solving that problem. Are you saying that President Trump just doesn't get it?
No, I think he gets it, but what are you going to do? You can't just sit on your hands. You got to at least show that you have a plan, right? And I mean, part of the plan is drill, baby, drill, deregulation of American resources. Hopefully that picks up. The problem, of course, is that Saudi price control has been so successful that nobody wants to drill, baby, drill. President Trump can deregulate as much as he can. He can encourage me and you to put an oil rig in our backyard, but we're not going to do it with oil at 60. So there is like a paradox for President Trump. He's almost too successful over the last 12 months. Saudi Arabia brought oil prices down significantly. That's been great, but that has also discouraged production, both in the US and everywhere else. That's the paradox of this, And so he can't look like he's not doing anything. And at least, let's say the 3 to 5 year plan, let's give a little bit more benefit to maybe the White House than 5 to 10 years. But at least he can say, hey, look, yeah, oil prices are back at 70, 75, maybe even $80, but we got a new guy in Venezuela and don't worry about it. In 3 years, we'll fix it.
It seems to me, just thinking about the way politics work, President Trump really needs to get gasoline prices in the United States as low as he can get them through the November midterms, because that's his best strategy to lock in the Republicans continuing to control the Congress and so forth. Is there a conversation he can have with MBS to say, look, you guys want to get away from oil revenue, let's make a nuclear deal, which it seems like they are going to sign a Section 123 agreement. Is there some deal that he can offer to Saudi Arabia to entice MBS to keep oil prices low and make them even lower through November?
Yeah, I think so. So I don't think all is lost. I think Crown Prince Mohammed bin Salman either told President Trump that the production quotas are going to go down, or he made a deal such as what you infer. I don't think, it's a foregone conclusion that Saudi Arabia is going to demand $70 to $80 prices tomorrow. But I mean, I just wrapped up an analysis on Saudi Arabia literally today, and I can tell you from just looking at the charts, the Saudis are starting to really run out of fiscal room, and they need to start issuing debt quite aggressively in order to finance a lot of their very ambitious and impressive priorities. And so I don't know the timing exactly. I think that Saudi Arabia can easily hold out until the midterms, give President Trump what he needs until then. But I don't think they're going to be happy that it's going to take another 11 months. And if that was the conclusion of the meeting, then for sure Saudi Arabia got something else in return.
Marko, how much value do you think the Section 123 agreement, which means the U.S. basically opening up its intellectual property sharing around nuclear energy technology with Saudi Arabia and allowing Saudi Arabia to leverage U.S. nuclear engineering capabilities, how valuable is that to the kingdom? How much, would they be willing to do in order to get that? Because it seems like that's the thing that's on the table.
Yeah, for sure. I mean, I think it's extremely, extremely valuable. But that's not going to solve Saudi Arabia's, not problems, but it's not going to solve for their ambition. At the end of the day, Saudi Arabia doesn't need like an alternative source of energy. What Saudi Arabia really needs is revenues from oil. It needs them in order to do fixed asset investment inside of Saudi Arabia. And while President Trump did allow them to share intellectual property on nuclear, he did also ask Saudi Arabia to invest money in the United States of America as well. And so that's just a lot of outlays that Saudi Arabia is on the hook for. They have to rebuild their entire economy. And by the way, I think a lot of the commentary about Saudi Vision 2030 is very, very critical. I actually think that 85% of it is pretty good. Yeah, 15% of it is kind of like big hero projects, like Ronaldo playing soccer in the desert, things like that. There's some of that, but I would say the vast majority of Saudi industrialization and modernization plan is very smart, is just extremely expensive. And on top of their own domestic agenda, you've got President Trump saying, hey, I also need you to invest hundreds of billions of dollars back in the US so that I don't impose tariffs on you. So nuclear program, nuclear IP, nuclear cool technology is not going to solve those problems. Saudis need money and they sell oil for a living. And so I think the time is running out. At some point, they're going to have to tell the US, look, we gave you 12 months, we gave you 18 months, we gave you 24 months, whatever, that ends up being. But now we need higher oil prices. And look, at the end of the day, that's not that bad. It's not that negative for the US economy. I think actually current level of oil prices are negative for the US in the long term. And I think they're negative because what the Saudis are doing, on one hand, they're complying with President Trump's directive and demand. On the other hand, they're also doing something that's good for them. They're keeping oil prices low, which destroys production outside of the Middle East, in the US, in the Canadian tar sands, off the coast of Nigeria, off the coast of Latin America. These prices are just too low for that production to come back up. And so that will benefit the Saudis because a lot of companies are going to go out of business. People are going to go bankrupt. Wildcatters in Texas are going to have to find a new job, maybe not go back to wildcatting. Like, the longer these prices at these levels sustain themselves, the more we're going to destroy permanent productive capacity. So I think what President Trump needs to focus on, if he wants to focus on affordability and inflation, he needs to prepare himself for a world where oil prices are at 80 and reduce costs of other parts of the U.S. economy through supply side reforms. That's the only way, because it can't just be energy that keeps inflation in check. There's got to be other things as well.
Let's bring the Russia-Ukraine conflict and the potential of a peace agreement. It seems like President Trump is pushing really, really hard for some kind of peace agreement in the Russia-Ukraine conflict. Could it be that the strategy there is to resolve that, to both take a victory lap on having accomplished peace, but then also to relax sanctions on Russia in order to bring more of that oil back into the market?
I think that it's all of that. Again, we're in violent agreement today with each other, so there's really, I think you've articulated very well. There's really two components of this. First and foremost, this is the largest land war in Europe, actually on the Eurasian continent, really since the Second World War. Absolutely, there's just a sort of a notch in your belt foreign policy accomplishment if President Trump can get Russia and Ukraine to sign some sort of a peace. Even a ceasefire, quite frankly, will be extraordinary. There didn't seem to be at all absolutely any attempt by the Biden administration to wind down this conflict. And so I do think that there's an element here where President Trump just wants to get it done because for the gram, as Drake would say. The other reason, though, is that I think that he does genuinely think that there can be an oil price and energy cost sort of benefit. I think that there will be, at least in the short term. When you think about Russia, Russia's actually exporting pretty much as much oil as it was before the war. But it's the diesel part that's the big issue. There's sanctions on diesel, and Russian diesel could flood the market, which should move all the other products down as well. So I do think there's potentially, let's say, 5% decline in oil prices if the deal just ends tomorrow. I just think that it's difficult to drive them further down. I think we're as low as we're going to get. Maybe Brent gets down to 55. Maybe WTI is at 50. I don't think we get lower than that. And in fact, I think the third reason that President Trump may be thinking that he can end this deal and why it's a good reason, and you can see this from some of the verbiage that's coming out. For example, the 28-point plan that was proposed by the American administration with Russian input. There were points in that 28-point plan that seemed to suggest that the U.S. and Russia will collaborate. And I think that there might be thinking in the White House that Russia can be flipped so that it's not as allied to China, what some people call the reverse Nixon. Nixon, of course, flipped China away from the Soviet Union and allied U.S. and China together. I think that there might be some attempt to potentially start that process as well.
Let's bring U.S.-China relations into the conversation then. What should we make of the growing tension there? There's also this potential conflict that just in the last few days happening around Taiwan in the South China Sea between various different naval vessels from different countries. Give us the rundown on what's happening and how we should interpret it, how it relates to markets.
Well, I think that Japan-China tensions could get ugly in 2026. You have the new prime minister, Takaishi, in Japan. She is a populist and sort of like more nationalist leaning, but her mentor was Shinzo Abe, who of course in 2012 kind of had this big reawakening of Japan towards national security concerns. But the other issue also is that unlike Abe and unlike previous prime ministers, her ruling party, the LDP, is no longer aligned with the pacifists who used to form a majority on behalf of the LDP. She's actually allied with this other party, the Innovation Party, which is a lot more aggressive on foreign policy. Now, they still don't have a majority, but, the bottom line here is that this is as aggressive and nationalist and foreign policy focused of a Japanese premier as maybe ever, even more so than Shinzo Abe. So I think that, she's not going to fall to Chinese pressure very quickly. On the other hand, I have to tell you, as someone who's observed China-Japan foreign policy and China-US foreign policy for as long as I've had a career, Chinese response so far is pretty muted. It's interesting to me that it's muted. China has a détente with the US. President Trump keeps calling President Xi his dear friend. He's about to go to China in first or second quarter of next year. And so, if I was running China, I would be a lot more aggressive right now towards Japan just to test the alliance. Can I peel the US off of East Asia? Can I get them to back off? Can I isolate Japan? And China's not really doing that. Quite frankly, like the economic, pressure on Japan thus far has been laughable. Now that could very well change. And so I would watch that very carefully over the next 30 days. But China seems to actually be more willing to put this to bed than Japan does. And that reflects that Japanese domestic political dynamic. But I think that the biggest story here, aside from the Japan-China tensions, is really US-China détente. One of the views I had even 18 months ago was that President Trump is really the only person on the planet that can make a trade deal with China. He's the guy that flew off in the plane. He's the only one that can land that plane. He is just like Richard Nixon, the famous statement, only Nixon can go to China. Similarly, really only Trump can make a deal. And I think that with his focus on inflation, affordability, the midterm elections, I think the big surprise in 2026 may actually be further unilateral, one-sided reduction in Chinese tariffs. President Trump may really be left in 2026 with no way to stimulate the U.S. economy other than to reduce the tariffs that he's imposed himself, provided that the Supreme Court, of course, keeps them in place. So I think that could be a big surprise for investors that the relationship between China and the US actually progressively keeps getting better for the rest of President Trump's term.
Marko, before we move on to U.S. politics, let's just assimilate all of these different geopolitical situations because there's so many of them going on. When you net this all together, what does it mean for markets and investors?
Well, I think that what it means is that geopolitics is not necessarily going to be a major driver. First and foremost, I think that oil had a terrible year in 2025. I think that it could have a better year next year. So that's, we already discussed the dynamic here. Saudi Arabian domestic priorities, I think, are going to take preference in 26 over American domestic priorities. Saudi Arabia can't keep doing America's bidding forever. The second issue is that right now, if you look at European defense companies, they're sniffing out effectively the end of the war in Ukraine. In fact, aerospace and defense equities, German aerospace and defense equities have broken through their 200-day moving average. They're just falling off a cliff. I think this is an overstated reaction. Just because the war ends in Russia and Ukraine, between those two, doesn't mean that Europe is going to stop rearming. In fact, Europe has many reasons to rearm. First and foremost, President Putin said today that if Europeans want a war, he'll give it to them. So it's not like Putin is going anywhere. But the other issue is that for Europeans, a lot of this rearmament is just a fiscal stimulus, and they're not going to abandon that. It's a sweet reason to keep stimulating domestic economy. So I would be looking for an opportunity next year to buy back into those sold off aerospace and defense equities. And then the final issue is China. Chinese equities are the best performing equities in 2025. It's not S&P 500. It's not Europe. It's not Japan. It's not emerging markets. It is China. And so what I would say is that if there is a genuine detente between China and the US, I think that Chinese equities could have even more upside. Remember, even though they went up 40% this year, it's from a very low base. Pretty much none of my clients in the institutional space, like sovereign wealth funds, pension funds, own any Chinese assets. And if they do, it's like 2% of their portfolio. You have many American pension funds that for various state legislative reasons are not allowed, like legally, to own public market equities in China. So what I would say is that there is a potential significant flow return to China as many of those institutional allocators, go from 2 to 4% allocation. And by the way, even 4% is pretty low. This is the second largest economy in the world, 20% of global GDP, and most institutional investors are only 2% invested. So what does all of this mean? If oil goes up, if European defense and industry does well, and if Chinese equities do well, we're really setting up for yet another year where the rest of the world outperforms U.S. equities and U.S. assets, which is what the story of 2025 really was. So that's where I think a lot of these things are headed.
Now, you told me off the air before we got started that you think U.S. politics are actually going to play a much bigger role than geopolitics in 2026 markets. Let's start with why you think that, and then dive in and give us the overview of what's going on and what your outlook is for U.S. politics.
Well, I think that the midterm election is, of course, important. Now, if I was President Trump's advisor, if I was in the White House, I would tell him, look, President Trump, you're going to lose the midterms. I don't need any polling to tell you that. That's just as close to science that political science gets. Presidents lose midterm elections. That's unless there's a major terrorist attack in the U.S., you're going to lose the midterm election. Now, I would be absolutely objectively correct with that statement. I get a sense that President Trump is not the kind of guy that likes advisors that tell him the reality, So I think he's going to try not to lose the midterm elections. So how do you do that? Well, you cannot have a slowdown in the U.S. economy. And I see a lot of forecasts out there by economists saying, like, look, the labor market is slowing down. The consumers are unhappy. The consumer sentiment is terrible. And so we're going to start seeing a retrenchment in consumption, which is 70% of GDP. And you cannot just have the AI capex boom hold the whole economy together. That's just, they just can't keep happening. There has to be participation by the largest component of the U.S. GDP, which is the consumer. So how do you stimulate in 2026? Well, the gut reaction by most analysts is, well, okay, President Trump will do more fiscal stimulus. I don't think he can do that. The bond market already rioted from September of 24 to February of 25. Bond yields went up 100 basis points as the Fed was cutting rates. Why? Because President Trump won the election and he campaigned on very, very profligate fiscal spending. The bond market reacted poorly. the Republicans in the House revolted. And what we got was one big, beautiful bill, which in my reading is not stimulative at all, especially if you combine the one big, beautiful bill with the tariffs, which are really just a consumption tax. When you look at all of that together, the US is not really running stimulative fiscal policy. And I don't think that President Trump will have any leeway to get anything through Congress, either because the bond market will prevent him from doing that, yields will go higher. And the second reason is you already hear, Senator Thune, the majority leader in the Senate, already saying kind of like, no, we should be paying down debt. We shouldn't be just giving $2,000 checks to American consumers. So I think that fiscal policy is done. So how do you stimulate then? What do you do? Monetary policy. That's the only path for the US to reflate the economy in 26, and in particular, to incentivize the consumers, which spent the last 15 years deleveraging. So if you look at, for example, household debt to disposable income, we're back in 1990s levels. If you look at household net worth calculations, if you look at home equity, a lot of this is higher. If mortgage rates and borrowing rates, so long-term rates, come down over the next 12 months, I think that you can reflate this cycle, and I think you can extend it significantly, particularly the housing market. Now, this was just an idea I had 6 months ago. We know since September, the administration has been talking about this. You've had Secretary Pulte talk about assumable and portable mortgages. You've heard talk of 50, 100-year mortgages. They're clearly focused on this. And you've heard both Treasury Secretary Scott Bessent and President Trump both note that they want to declare a housing emergency. You've got President Trump being criticized for affordability. Well, that's not because toaster ovens have gone up in prices. It's not really because of tariffs. The reason affordability is poor is because the kind of goods and services that make you a member of a middle class are extremely expensive. And that's not an iPhone. It's not a TV. It's not a tradable good that you import from China and slap a tariff on it. It's actually tertiary education for your kids. It's the roof over your head. It's the healthcare, and it's daycare. Those are the things that are very expensive. Those are the things that Mamdani and Trump agreed together in the White House. And so what I expect President Trump to do is focus on the affordability of homes and bring down borrowing rates and basically reflate a housing cycle. I think that's the biggest story in 2026. And I think that the reason he's going to have to do that is just he doesn't have any other options. Fiscal policy, fiscal lever, we've used them up. Joe Biden used them up. The Trump-Pelosi administration, as I like to call the 2020 post-pandemic stimulus, they used them up. And President Trump in 2017 with that pro-cyclical fiscal stimulus, he used it up as well. So it's now up to the Fed and monetary policy.
I'd like to ask you to comment on I guess I'll call it a war of two narratives. Our friend Eric Peters over at One River Asset Management has expressed a view very similar to some of what you just described, which is, look, President Trump is going to try, whether it's possible or not, he's going to do everything he possibly can to win the midterm elections. Therefore, he's going to goose the markets. He's going to do everything he can to stimulate the economy. This has to be good for Wall Street. But if you listen to Scott Bessent's actual statements, he's been very outspoken in saying Wall Street's gotten too much of a free ride. It's Main Street's term. Our policies are going to focus on Main Street. Now, obviously, that's what voters want to hear, so that's what he's going to say. Does it mean that the things they're going to do are not really going to help Wall Street and that markets are going to be disappointed? Or is it really the case that in order to satisfy Main Street, it's still going to be very bullish for financial markets?
We finally have something we disagree with, which I'm happy. It's a great question. And I concede that you're correct, that is what Scott Bessent was saying in January of 25, in February of 25, in March of 25, and April of 25. But since April of 2025, I haven't heard Scott actually say that. He used the term detox. We're going to detox the economy from Joe Biden's socialist policies. That was like one of the verbatim quotes. There was a lot of that, your point, Main Street over Wall Street and so on, but they've actually stopped using that terminology. And I suspect they stopped using that terminology because they are starting to realize a very important truth. The stock market is the real economy. It's the top 2 deciles of American income distribution that are doing all the consumption. If the stock market slows down, they're going to stop consuming. And so President Trump and Scott Bessent, not really for any fault of their own. I mean, I think this is just where we are as a country. They just happen to be in charge right now. But, the reality is that if the stock market slows down, they're going to have to eat a recession. And they don't seem to be willing to do that. Now, I do think that Scott Bessent may have been willing to do that in January, February, March, and April of 2025. The problem was that at the time, the bond market didn't react the way I think he thought it would. Yields stayed stubbornly high. We hit 4.8, I think it was in January, and then 4.6 after those April tariffs. And so if you had a recession with yields that high, like it's game over, right? Like it's like emerging market, like balance of payment crisis. It's game over. And so I think they correctly focused on, rationalizing the tariff policy, and guiding the economy to where we are now. But yeah, I don't see any more chest beating from them. And I think that they are going to focus on mainstream, as you say, but in doing so, because they no longer have fiscal room to maneuver, they're going to have to use monetary policy. And if you cut rates for consumers, you're going to be cutting them for everyone else, including the AI capex, tech bros, including Wall Street, including hedge funds. You're effectively going to steepen the yield curve. The Fed is going to cut rates aggressively after May in particular. And I don't see how that's also not very good for Wall Street. So they're going to end up creating, I think, an even bigger bubble. And at the end of the day, it's probably going to be somebody else's problem to clean up after this administration is gone, which is convenient, politically.
Well, I'm sorry to disappoint you, Marko, but we're actually still in violent agreement. I tried to express both sides of that argument, but I agree with you that I think what's going to happen is President Trump is going to do absolutely anything that he can to win the midterm elections. No policy action is too reckless, and no longer-term consequence, such as inflating a bubble, is going to slow that down. He has to win the midterm elections, and I think in his own mental model, that's something he has to do no matter what. And the fact that guys like you say it's impossible is not even going to hit his radar. I think we do agree very much on that. Let's talk about which, if that's your view, and I think we share that view, which markets benefit the most, which markets don't benefit. Where's the longs and the shorts in this story?
I'm going to tell you a funny anecdote to answer this question, because I had this hilarious interview a couple of months ago with a journalist I won't name from a newspaper I won't. But basically, I got a call, very angry journalist on the other line. And the line of questioning was basically President Trump in 2026 will replace Jay Powell with a chocolate Labrador. The independence of the central bank will be eroded, and that's bad for the stock market. To which I answered, independent central banks are not good for the stock market. They're bad for the stock market. Independent central banks are not good for the bond market. They're bad for the bond market. Allow me to explain. Turkish and Argentinian stocks, what have they done over the last 25 years? They've outperformed the S&P 500 in local currency terms. But let's leave that aside for a second. What causes a recession? What causes a bubble to pop? It's the independent central bank being that prudent adult in the room, shaking their little finger at us, saying, you've been naughty. We need to raise rates. What causes bond yields to go up? It's the central bank shaking its finger at policymakers, saying, you've been fiscally irresponsible. Here come the bond vigilantes. Fix your fiscal house, or else we won't support the bond market. Anyone who wants to short stocks in 26 because President Trump is going to put his Fed chair, is basically going against history. Erosion of independent central banking is amazing for equities. It's YOLO time, baby. But there is always a price to pay. There's no free lunch. So what is the escape valve here? It's the US dollar. And so I don't want to give you a negative S&P 500 forecast for 2026. What do I think the S&P 500 target is for next year? Who cares? It's up. But the question is, what should you do with your money? Should you put it in that asset that's priced in the dollar, or should you find some other asset that's maybe priced in the euro or renminbi? Because if the US dollar has another year where it falls 10% as it did this year, 8-10%, it staged a little bit of a mini rally at the end. But my view is that I think that's unsustainable. I think that in 26, the obvious trade is not to short duration, expecting some sort of a bond carnage because President Trump is responsible, or to, short stocks because somehow independent central banking is important for equities. No, no, no. I think the way to play domestic politics in the US is to effectively try to play with dollar weakness. And I think that calls for more exposure to non-US assets. That's fundamentally what I would say. Now, this isn't a debasement of dollar thesis. This isn't some sort of complete loss of independence of the central bank. I see a lot of slander being thrown at Kevin Hassett, which is unfair. This was a man who was chief economic advisor to Mitt Romney, to Senator McCain. It's not like he's completely clueless as to how monetary policy works. And I don't think that President Trump is really doing anything that extraordinary. He's just going to allow American monetary policy to be more dovish than it should be. Like, oh no, that's literally what every president has done over the past, I don't know how long. And so I don't think that's that crazy. I just think it's going to happen. And it's going to happen for these political reasons we articulated together. And I think that's going to be negative for the dollar. And I think the best way to play it is to just find something that's not priced in the dollar. And what's funny about this is we're in the middle of this AI super cycle. AI is apparently the greatest thing since sliced bread. But when I was in Zurich and Munich a month ago, 2 months ago, everyone's super bearish on Europe. Everybody, every German I met is like, we live in a museum. This is terrible. America is so much better. But with their second breath, they complained that they made no money in the S&P 500 in the midst of an AI bull market that's supposedly geographically domiciled in the US. And so what's the bigger macro story then? Is it AI? Or is it the fact that if you're domiciled in Europe and denominated in Swiss franc or the euro, you made no money in S&P 500? You actually lost money in 2025 because you owned America. That's how important these currency moves are. And so that would be my case for why 2026 is going to look a lot like 2025, at least in terms of relative global equity performance. And for anyone listening to this, a lot of obviously listeners are probably based in the US. All I would say to you is like, yeah, I'm not bearish on S&P 500. Hell no. It's just that you might want to take some of the money you made in the S&P 500 over the last 15 years and just expose yourself, diversify to just things that are not priced in dollar. And yes, many of your listeners probably already are in gold and Bitcoin as a form of diversification. I think that's a little bit too like World War III-ish. If there is no recession, there's no need to be in safe haven assets. Own some European equities, own some Chinese equities, own some Japanese equities, just diversify. And I think you'll be okay.
Let's come back to Kevin Hassett. Just in the few minutes that we've been recording on Tuesday afternoon, Bloomberg's been reporting that apparently President Trump has made an announcement that he's going to announce who the new Fed chair that he's already chosen is early next year. So it sounds like he's intentionally signaling that it's going to be a secret until after the first of the year. Do you think Kevin Hassett is the shoe-in? Is that who he's picked? If not, who else is on the table? And what will the consequences be when that is announced? And we have a new Fed chair next. I think it's May that Jay Powell's term is over.
So I've always thought that it's Hassett. He has the credentials. He has he was, I think, a professor at Columbia of economics, and then he went into sort of think tank world, more of the center-right, American Enterprise Institute, and so on. As I said, he's been the economic advisor to the political campaign of every Republican president before Donald Trump since Bush Jr. So I've seen a lot of sort of Kevin Hassett slander out there. And I don't know the man. It's not like I'm pro-Hassett, but my point is the slander has been kind of ridiculous, that he is just a Trump guy. That's just not true. The man has been in 25 years an advisor to every single Republican president. So now you could argue that the monetary policy of every single Republican president was maybe bad, we don't know. But my point is that he's very experienced, and I think that he's clearly President Trump's choice. I don't think that he is a chocolate Labrador. And I think this is very important. Will bond markets riot because it's Kevin Hassett? Maybe initially because too many bond investors read the New Yorker or New York Times. But the reality is that he's going to go in front of the Senate. He's going to answer the questions as a guy who has a PhD from UPenn. And he's either going to get confirmed or not. But that's going to depend on those answers. And those answers, in order to be confirmed, are going to make the bond market realize, oh yeah, he's just going to probably be more dovish than he should be, but not on some emerging market level, just on the level that we've seen before. I mean, why did we have the housing crisis, for God's sakes, in 2007? We're all pretending, by the way, as if somehow the Fed has been a paragon of central bank independence. I mean, there's a reason we had a housing bubble in the United States of America. The Fed kept interest rates too low after September 11th and after the tech bubble blew up for 2002 to 2005. Similarly, we did a ton of QE after the GFC that didn't really do anything. And then after the 2020 pandemic, Jay Powell kept interest rates too low because he thought that inflation was transitory. Really? Really? In 2021, you've got the Mexican central bank raising interest rates like crazy, but the Fed is not. Why? Maybe President Trump should authorize a bunch of H-1B visas for Mexican economists because apparently the ones in the Fed don't realize that $5 trillion worth of fiscal stimulus is going to cause inflation to not be transitory. My point is simply this. Just in the last 25 years, I just articulated 3 examples of where, yes, monetary policy in the U.S. was way too dovish. If President Trump is the 4th iteration of this, it doesn't mean America's become Turkey. It means America is in America. And we're going to have another bubble. Act accordingly.
Marko, let's assume that Kevin Hassett is President Trump's pick for Fed chair. I definitely agree with you on that. But boy, if I try to connect the dots here, it seems like all the spin I'm hearing is Democrats are probably trying to pre-position, okay, let's tell everybody that Hassett is Trump's boy. He's not independent. He's not suitable. We got to keep him out of the Fed. Now, the Democrats don't have control of the Senate, so how much resistance can they present? Can they prevent Hassett from being appointed, or are they just going to make a bunch of noise about it before that ultimately is the outcome?
I think for sure, for some reason that I don't really understand, Hassett has attracted the ire of the Democratic Party and sort of just liberal intelligentsia. What's ironic about that is that may succeed in the Senate. You know, a few conservative Republican senators could end up voting against him. They may be swayed by this sort of risk that he is going to do President Trump's bidding. But I just think that means the next guy or girl gets confirmed and is probably going to do the same thing, which is not really do President Trump's bidding verbatim. We're not going to go to 0% interest rates. But is American monetary policy, is the Fed funds rate going to be 50 basis points lower than it should be? Yeah. And that's going to happen whether it's Hassett or anyone else as the Fed chair. So I both think that, yes, you're right, the Democratic Party and, sort of liberal media will paint Hassett as some sort of Donald Trump chocolate Labrador. But I think it's kind of silly because whoever else replaces him is not going to be their favorite pick either. You're just going to have another Fed chair that will run monetary policy slightly more dovish. And again, I just want to reiterate, this has happened 3 times just in the last 25 years that I can articulate just like this, just BSing with you back and forth on a podcast without even showing any charts. I don't think we're in a world where the U.S. becomes Turkey or Brazil. We're just in a world where we're going to have monetary policy that stimulates the economy because we're out of fiscal bullets. It is what it is.
Marko, I can't thank you enough, as always, for a terrific interview. But for the benefit of some of our listeners who do want to see those charts, tell us a little bit about what you do at BCA Research. What is the Geo-macro function that you have basically created there all about, and how can they find out more about it and follow your work?
Yeah, thank you. Thank you for double-clicking on Geo-macro. I'm trying to make it catch fire. Basically, my premise as a strategist is that in 2025 and beyond, you can't really be a macro investor unless you incorporate politics and geopolitics into your framework. So it's not a nice to have. It's not the icing on the cake. It's in the batter. If you just focus on macroeconomics, or if you just focus on momentum or valuations or bottom-up analysis, it's just not enough. And so that's what Geo-macro is. It's a blend of politics, geopolitics, and macroeconomics, where basically I don't differentiate between these frameworks. I use all of them. And so at BCA Research, I run that strategy. My job is really to call the 5 big asset classes, as I like to call them: the S&P 500, the dollar, the 10-year yield, gold, and energy, oil. I think if you get 3 out of those 5 right, you can get everything else right in your global asset allocation. So that's kind of what I do. And they let me do it. And I'm very, very grateful to BCA Research for giving me the platform to put my voodoo to the test, and it's worked really well for the last 2 years. I've been extremely bullish last 2 years, particularly this year. My S&P 500 target was 6,950. We're not going to reach it probably by the end of the year, but we're going to be close. And I think one of the reasons that I've been right is that sometimes, yes, macroeconomics looks bad, but policymakers are what we really need to forecast. It's that second order effect that we need to really think about. It's not just the first order. It's not just what's linearly extrapolated mathematically from data. It's how do policymakers react to it? And without that, I don't know how you can really be a macro investor.
Well, I look forward to having you back in 2026 for an update. Patrick Serezna and I will be back as Macro Voices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Serezna.
Eric, it was great to have Marko back on the show. Listeners, you're going to find the download link for the Postgame Trade of the Week in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Marko's picture saying, looking for the downloads.
Patrick, Marko made a strong case that Europe's defense spending cycle is far from over. We've seen some recent profit-taking in the sector, but he argues that the fundamental trend is still firmly upward. You've put together a trade of the week that captures that idea. Walk us through it.
Eric, one of Marko's most actionable points was the dynamic in European defense. We've seen some profit-taking in the sector on expectations that a potential ceasefire might cool defense spending. But Marko was clear. Europe's rearmament cycle isn't ending, it's just beginning. Defense budgets are now a political necessity and a long-term fiscal policy. With many of these defense names pulling back, it creates a constructive entry point. So this week, I want to put on a bullish European defense trade consistent with Marko's thesis. Now, the tricky part for our North American listeners is that most of the ADRs for the major European defense contractors don't have listed options, so the trade has to be expressed in a basic Delta 1 form. Luckily for investors who have access to European markets, the individual stocks and their options are quite liquid. So for this week's trade, I want to focus on the largest name in the European defense complex, Airbus, trading on the Paris exchange. The stock has already seen about a 16% peak to trough correction, which sets up a tactical opportunity to position for a resumption in the broader bull trend as we move into the first quarter of next year. I want to be long the stock here, but to use a golf analogy, I'd like to pay a small price for a mulligan, something that softens the drawdown if my initial timing is early. One way to do that is by overlaying a bit of downside convexity. In this case, with Airbus trading at $198, you can look at the January 190 to 170 bear put spread, a 20 euro wide structure trading around 3 euros. If Airbus has one more leg lower before the potential bull trend resumes, any profits from the put spread can be used to reduce the cost base of your longer term position. It's simply a way to stay constructive while being honest about the near term tactical risks.
That explanation worked for the pros, Patrick, and of course our retail audience already knows they can get the full briefing by attending your Monday webinar, which always dissects the trade of the week in detail. And since we've gotten a lot of positive feedback on the trade of the week segments that we've been doing, Patrick has decided to expand on the idea. Patrick, what do you have in mind?
Yeah, Eric, the response has been fantastic. So in 2026, we're turning this into a full-blown initiative. It's called the Asymmetric Trading Challenge, and the goal is simple: to help serious traders master asymmetric setups in real time with real guidance and real accountability.
Okay, so this is more than just a few good trade ideas then.
Much more. It's an entire year-long challenge, live training, trade breakdowns, a full system to help you protect and grow your capital in any environment. We're going to give you everything you need to level up.
So where do people go if they want to find out more?
You will find the link in the Research Roundup email, or just head to bigpicturetraining.com/challenge to sign up. We're doing a special live webinar on Tuesday, December 16th at 4 p.m. Eastern Time with all the details. Again, that's bigpicturetraining.com/challenge. If you're serious about trading asymmetric risk like a pro, you won't want to miss this. All right, Eric, let's dive into the equities.
Since November 21st, the S&P has traded above its 5-day moving average, implying strong upward momentum, and we're back above all the longer-term moving averages, including the 50-day moving average. So now the question is whether this market can Santa rally its way all the way up to new all-time highs by year's end. I'm on the fence about that one, Patrick. It looks good so far, but the stochastics are already topping out, short-term oversold, so it's probably time to dip below that 5-day and see what happens. And I think that's the key, is what happens if we get a little bit of a dip below the 5-day. Is it another rollover back towards another correction or a deeper correction, or is the 50-day moving average going to hold this time? I think it probably will, but to my thinking, that's the key, is the 50-day going to hold? If we go back down from here and test it, it's fine with me, as long as we don't close below it. If the 50-day does hold, I think we have a good shot at a nice Santa rally from here, but I'm not betting on it.
Well, Eric, in my mind, the S&P 500 has now officially had its correction. We've been talking about for months that we were overdue for a 5+% correction. Well, we got our 6% correction. A lot of metrics were quite oversold. And now that the market has resumed back to its highs, there is an equal chance that this market can actually break out to higher highs, as it is that this is a bigger topping formation. Now, what will be the deciding factor is what happens in the middle of the month. We have the much anticipated FOMC meeting and press conference, as well as the delayed jobs numbers releases that are going to give a really good sense as to whether the Fed is going to have to be on a dovish pivot in order to keep the economy going. So my positioning for the next week really is that the market is going to stay in this holding pattern at least for another week. All the information is going to be released in the middle of the month, and so very likely the overhead resistance will be its highs, which is within 100 S&P points, and there's no reason for us to at this point dip back below the 50-day moving average till we're past that data point. And so the next 1 week is far more likely to be trade range bound, and we're going to really see what the bulls have in store once we get past those major news events and whether there's going to be a Christmas rally in the final few weeks of the year. All right, Eric, let's touch on that dollar.
Well, the short-term trend line that's been in place since late September or so has broken to the downside now, but only by a little bit, and that downside break did not seem to bring on an acceleration to the downside. It didn't bring on more momentum down. So I think we're still on the fence here between continued consolidation and upside breakout on the Dixie chart. My prediction is that the outcome will ultimately be headline-driven, and Trump and Bessent's next moves are probably going to decide the next leg.
Well, it is important to note on the dollar here, Eric, that this is the first close below the 50-day moving average in months. So there was, for months, an opportunity for the U.S. dollar bulls to actually get something going on the upside, including against that U.S. dollar yen. We saw an extraordinary rip to getting it within a stone throw of its previous year's highs. And so there was this big dollar impulse already. So with it all rolling over, the question really now becomes, is Marko's view on the dollar going to be the one that prevails? Is this breakdown potentially going to start there? There's a lot of implications, because if the dollar resumes selling on the downside, it means the reflation trade is still on, and overweight into emerging markets, international equity, and into commodities becomes a big theme. And so watching whether or not this close below the 50-day moving average is something more than just a one-day dip is definitely the thing to watch. All right, Eric, let's touch on crude.
Cushing inventories are now at operational minimums, yet backwardation at the front of the WTI curve is muted and only lasts for the first 4 months out on the curve before it flips back into moderate contango. So my outlook is unchanged. I think the fundamentals are decidedly bullish, but I also see room for invisible hands to keep oil prices low through the midterm elections, as I discussed with Marko in the feature interview.
Well, Eric, crude oil has been selling for almost 40 days now, and it has failed to have any acceleration to the downside that has broken it to a lower low. Now, we still have a couple of news catalysts, like a potential peace deal between Russia and Ukraine, and or the outcome of the Venezuela escalation. But overall, oil has held in very well. And so at this moment, there is divergent momentum from things like the momentum indicators, which is showing that the downside momentum has dissipated and in fact actually reversed. So with the fact that many energy stocks are actually taking good positive flows, I'm speculating here whether or not oil is capable of actually closing above $60 in the coming weeks. If we see a weak U.S. dollar with a crude oil breaking out higher dynamic, that could spur a new bull breakout. But as of this moment, it's not a bull breakout. Oil is still in its primary downtrend, still holding below the 50-day. So this is early speculation as to seeing whether or not we're going to see a turn point here in the week to come. Eric, gold's been moving. What are your thoughts here on it?
The formative breakout from the symmetrical triangle formation that we discussed last week completed to the upside with vigor. So exactly as we expected, looks like the bull move might be back on. But now the very short-term slow stochastics have run from oversold back up to short-term overbought, and they've already started to roll over. So I think gold is taking a little pause here. The question is, how long and how deep of a pause? Is it just going to tread water, or is it going to take a dip here? If we can get to new all-time highs, the measured move targets are in the 49.30 to 51.20 range, depending on which bottom you measure that last move from. So the question is whether or not this correction is fully over, and I think it probably is. But with the stochastics already rolling over, I think we could see a dip in the next few days before that rally resumes.
So, Eric, gold's consolidation has been now going for 45 days. I was highlighting that the previous 4 corrections in gold consolidated sideways, and they were anywhere from 2 to 4 months in length. So if gold broke out here, it would have been the shortest correction that we've seen. But we are bullish and we're looking for bull continuation. What is one positive sign is that on page 7, I have that chart of silver futures, and silver has already broken out of the pennant to the upside and is actually ripping higher with a lot of momentum based on silver shortages. At the same time, the gold miners have already broken to higher highs. And so we have a lot of momentum coming in here. Platinum and palladium also starting to turn up here. There's a legitimate chance that in the month of December, we will see gold attempt to break out to an all-time new high. Will we see that breakout here in the next week? Or is it going to be one of those things that is going to happen after the FOMC and the jobs numbers release later in the month? I'm speculating more on the later in the month kind of scenario where we'll already be at a 2-month phase of this correction. But I am bullish on gold. This is just a matter of timing of when some new bull run can really get underway here. Eric, what are your thoughts here on uranium?
Well, Patrick, I couldn't possibly be more bullish about uranium and uranium miners. long term. The long-term fundamentals couldn't be better. But in the short to intermediate term, I'm getting a little bit nervous about this chart. The uranium miners are looking, well, kind of dead cattish to me. The S&P is rallying like the correction never happened. We're maybe headed toward, new all-time highs. But URA and a lot of other charts in the sector look really dead catty. Yeah, they're recovering. The direction is up, but they still haven't even retraced as much as a 38.2% fib retrace on the correction. And the short-term stochastics have already run back up to short-term overbought, implying that maybe a dip or consolidation's in the making. If that happens, and particularly if there's any broad market weakness to accompany it, we could see a new lower low here. If that happens, I say it's still a buy the dip opportunity. The thing is, I don't know how far it's going to dip or how long it's going to dip before we see a solid resumption. I don't know why we haven't seen that resumption. I was expecting it in sympathy with the S&P. Oftentimes, uranium will bottom before the S&P and it will recover before the S&P. Now we're lagging the S&P when we should be doing the opposite. So I'm getting a little bit nervous about this chart short term. But again, whatever happens bad to the downside in the short term, I see as a buying opportunity.
Well, Eric, when looking at the chart on page 8 of the uranium futures, overall, uranium's just been consolidating, and it could easily bullishly break out. But on the topic of uranium stocks, well, they have now officially corrected 50% of the prior rise. And so while there's no evidence yet of a bull continuation pattern getting underway, we've already seen a deep enough correction for inevitably buy on dip traders start to defend these areas here. And so, while maybe a breakout in uranium is not imminent, I do think that these are price levels that are interesting and certainly a level that I think is worth watching here. Now, Eric, we haven't touched on copper in a while, but we just had a fresh breakout. How do you size this up?
Well, Patrick, the big move up to new cycle highs on the U.S. high-grade copper futures chart pales in contrast to the much greater action on the LME, where copper demand for the physical metal has been staggering. Goldman Sachs has a note out saying that this is probably all about Asian demand, with the immediate apparent buyers being Taiwan and Korea, but Goldman speculates in their research note that it's eventually all winding up in China. Given the growing tensions between China and Japan that Marko highlighted in the feature interview, this, I think, is going to be an important signal to watch.
Well, technically for me, it's a pretty significant breakout to higher highs. I have that chart on page 9. It's significant because it has broken all of its previous highs other than the tariff bump, which was then removed out of the market. So if it wasn't for that tariff volatility, this would have been a break to 52-week new highs. Now, copper is measuring out for a test of like the 575 level on the upside. So it retesting that July high that was caused by the tariff bump is 100% on the table. Definitely a bullish breakout. All the copper plays are getting going. And so copper is definitely a hot place to be right now.
Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
We have seen Treasury yields kind of settle in. The interesting part for me is how much will a potential dollar breakdown play into determining the short-term trend of yields. Now, we have seen that 4% level more or less hold at this stage. We're hovering right at the 50-day moving average and the descending trend line. So seeing whether or not yields can break higher from here is going to be a big technical signal. And we'll be watching whether or not there is going to be a pivot here on what's been generally a pretty bullish Treasury bond market for the last 6 months. Will that all end with higher yields?
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the link to join the Asymmetric Challenge webinar we talked about earlier in the postgame. There's also the transcript for today's interview and the Trade of the Week chart book we just discussed here in the postgame, including a link to a number of articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. And also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.